in terms finally of looking at the overall structure of the sector and the significance both of the general conditions and also of changes in regulation, are we expecting to see significant changes in the structure of banking systems? Are particular countries, maybe countries where there is still a relatively fragmented system, going to see more consolidation? I guess that's a good place to start, first of all. So Eric, do you want to go first, and then we'll come back to David?
Here again, I think if you think about consolidation and if you think about the structure of the industry and how it is likely to change in the coming years, I mean, you also need to think about various places, various business models, and you already have examples of forced consolidation, and we were discussing Spain as one example, and clearly that is forced consolidation. But as a result of a change in the regulation, and whether it's imposed by the regulation or a choice by the institution, you might see, and you will see, some banks decided that their business model is not suited to the new regulatory environment anymore, and they will decide to, they will again decide or be forced to execute on separating some activities, and that may mean splitting into two pieces and then merging one piece with somebody else, and so that is very likely to happen. It is very possible that as two businesses just do not fit together anymore in terms of the cost of carrying the capital of one business versus carrying the capital for the whole of the institution. That's very important. And then you will have other situations where the funding imbalance that we were discussing at the beginning of that round table is going to remain too great after deleveraging, after market conditions stabilizing, hopefully at some point, and that funding imbalance is going to cause institution X or Y to decide that it also needs to either change its business model or get together with somebody that can help them there.
The pressure for consolidation. I mean, we've talked a lot in the last hour and 20 minutes about the discrimination between the haves and have-nots. Well, I mean, the solution to that ultimately is the Darwinian one of the haves, consume the have-nots, or at least their business models, wither on the vine. Eric, as you say, particularly on the retail side, we've got still a tremendously fragmented financial services industry in Europe. Pressures for profitability will definitely drive economies of scale as a means of regaining P&L that's been lost to the funding markets, or the financing markets. And I think we're also seeing the emergence of global lines of businesses, be it investment banking, treasury services, asset management, private banking. So it all looks very obviously a trend towards consolidation.
Maybe just, one comment on that as well. Generally, I think there will be less capital available for banking in the medium term. Especially if we're going to see more this pressure on the regulatory side being effective, and that I think will ultimately drive the size of the whole industry. Clearly, there are also some countries, for example, like in Germany, where we see strong political pressure indeed to maintain structures, and so this can indeed take decades before this is sorted out. We had some hopes that it could be maybe faster through the crisis, but what now we see, and that was mentioned, too big to fail, or who is doing lending to medium-sized enterprises and all those things, to that there's certain persistence to keep businesses alive. But ultimately, I'm quite confident that due to the scarcity of capital in the banking sector, we will see some consolidation.
I mean, presumably there's a cross-border element here, and David touched on this question of what happened to the Greek banks as a result of the sovereign situation. Presumably in some of the countries that are being pushed into that sort of have-not camp, foreign banks in that market then have, if they're from the have camp, if they have a strong funding profile themselves, presumably then have a competitive advantage, which, if that sort of dichotomy of funding conditions persists, is going to affect the structure of banking markets in some of these countries where there are foreign banks present. Is that something, does that make sense?
Yeah, I mean, you would definitely think so. I think the evidence to date, anecdotal it may be, is that in some of the challenged jurisdictions, the foreign banks are actually exiting fairly quickly, and in terms of disclosure, which is one of the first themes we talked about, I mean, banks are very quick to say, my exposure to this country is X, my exposure to this country is Y. Adding to those exposures at this point in time doesn't seem appropriate if you're fortunate enough not to be domiciled there.
And I would add to that even if you're in the camp of the haves, and even if in your domestic market where you're presumably one of the national champions, your funding profile looks healthy, it's highly unlikely that your retail deposit base will be such that you just have excess liquidity which you then can go use to fund adventurous businesses in other parts of Europe or the world. And it's equally unlikely that in those parts of the world your operations will be self-funded, particularly if you start growing aggressively at a time where one could doubt whether that makes a lot of commercial sense.
And I'm just finally looking more at that at the international aspect, and I'm aware that everyone around the table is more focused on the European region, but are we seeing, as is much talked about in economic terms, also the same in banking terms, that some of those emerging markets, as David mentioned at the beginning, where banking sectors have come through this crisis in better shape, are going to become more significant players outside home markets, or indeed in markets where European banks had originally expanded into? Are we seeing sort of banking going local, or the balance of power shifting in that way, or is that still a very long process overall?
Beyond the fact that some banks in some places have performed better, and what it may mean in terms of those banks going after the European banks, I think you also need to think about that. If these banks are in faster growing economies, effectively they also need to fund their balance sheet going forward. And if there is a lot of growth, in many cases, the balance sheet has its imbalances and that needs to be funded. It does not mean that even if you take some of the Asian banks, they will have the spare capital to effectively invest in Europe. And by the way, would they want to allocate that capital to slower growing economies, which is another question. Finally, it actually also raises the reverse question, which is, if you are a European bank that has the majority of your balance sheet in a low growth economy, you need to think going forward, very cautiously about, whether that part of your balance sheet, the low growth part of your balance sheet, can fund the fast growing part of your balance sheet. So, where do you raise capital from if you need to raise capital? Strategically, you might want to go into faster growing places, because that's one way to show to investors that you have a business model that's going to continue to grow. At the same time, because of everything we've discussed on funding and raising capital, you need to think very hard about how much that's going to cost you, where you should raise the money, whether you should raise it locally, whether you should raise it centrally. Some banks have decided in the recent past to list their subsidiaries in some countries where they have a strong presence, even though it's not a domestic presence.
Sort of Santander, Brazil.
For example, there were a number of reasons, obviously, for Santander to make the decision. But I'm sure that one of the reasons might have been that there are different growth dynamics in different sides of the balance sheet, and that's something to bear in mind when you raise capital.
A lot of the acquisitions may be more about technology transfer. They may be more about building out or indeed building global business lines. But so, for example, be it private banking, asset management, etc., you can see those would be logical assets to acquire. It's very difficult to see, because you say a bank in a high growth region wanting to acquire, a commission-induced disposal of a branch network in a low growth sector. I mean, how do you possibly justify that?
Well, that's been an excellent discussion. I'm aware that people have meetings to get to, so thanks to all of you for contributing today, and I hope you also found it enjoyable and informative as well. Thank you.